Crystal Gazing Summit. Welcome everyone to this panel discussion. Amit, Sonam, Anirudh, we have been kind of waiting to connect for this very, I would say, insightful debate, which I think, many of our clients and investors are also wanting to understand how to dissect decision making between quant funds versus human based funds. And that is why, we thought of this topic. So, we have only one lady fund manager in this entire forum. And Sonam, I was like reading your post on social media where you mentioned that Spot the only lady fund manager amongst 37 fund managers that we have, in this entire forum. So my first question to you, we have seen quantitative analysis, mathematics, algo leading to unbiased decision making. But does that mean that human intuition can entirely be ruled out while quant funds like yours ultimately take daily decisions of building up portfolios?
No. So Kamal, here I would like to say that, see, even all the quant funds that we have, right? They're all based on philosophies that humans have sort of thought of, right? So if we create a momentum strategy or if we create a value strategy, all of them are based on this hypothesis that human behavior guides, right? So a value investing is based on this hypothesis that any stock that is undervalued will see a lot of buyers. Momentum investing is based on the hypothesis that any stock that has picked up trend will continue to go pick that trend because investors will jump into it. So everything that we do as quants only works because there are these human biases and these philosophies that are inspired by these genius investors that we try to quantify and create a system out of. And with that system, what we're trying to do is become a little bit more consistent. There is no overhang of decision, and it is much more reliable in that sense. So definitely, quantitative genius is something. I mean, human genius is something that still is extremely powerful. And what we try to do is we do try to quantify it and make it more systematic.
Sure, Sonam. Anirudh, you have been enjoying the title of best PMS in 2023 with 135% returns, and it is like stellar returns. Year has also been good. So I want to really understand, who do you attribute your last 1 year of 135% return to? Is it quant, or is it a human genius?
So thank you for the honor, Kamal. But as I always tell it to all my investors, whenever you're investing at INVasset, come with a 3-year view. So any CAGR less than that, it's sometimes just for a particular year. So thank you for this 1 year best PMS thing. Yeah, we are a quant PMS or all, and all are, as Sonam rightly mentioned, that quant is entirely based on your experience. We've been into the markets 30 years as a prop fund, and all that we've learned, we've just coded it so that when we are on the pitch batting for our investors, that odd ball that comes around, our system tells us not to mingle with it. So just sticking to what we know, sticking to our basics has helped us generate these returns. And quant sometimes I feel is very misrepresented throughout. Like quant people are just playing with it. Quant is a very beautiful way of getting your things in place. You have learned something, but are you able to practice it when it comes to the real thing? So quant helps you at, if you ask me as a fund manager at 19,500, 20,000, I was very skeptical that I thought that the Nifty and the markets, they are they've turned very expensive. But when you put it in your multimodal quant model, it tells you that these are the risk reward ratios. This is how it has happened in the last 15, 20 years. This is what the psychology there has been. This is how the investors were behaving. So yes, quant gives you a clarity. If you've researched it well, it gives you clarity. And yeah, we are a quant fund. We focus only on quant. And then when we get the companies which our quant system gives us, then our research team takes over. So yes, I think we get a little bit of advantage in terms of where to start, and also in terms of the bias. We do not have any type of bias, so it also helps us a bit.
Sure. So you are attributing your success to quant.
Absolutely.
Perfect. So moving on to you, Amit, you are the only human fund manager amongst this panelists that we have today. I want you to understand, I want you to kind of, give your views on this aspect that while doing portfolio management, decision making in equities, do you believe that the advancement of AI, machine learning can rule out the role of human decision making while, resolving the complexities of daily market movements? You're on mute. You're on mute, Amit.
Okay, good morning, everyone. Thank you so much, Kamalji, for inviting me on this panel. I hope everyone's having a good Saturday. Coming to your question, Kamalji, fundamentally, if you think about it, the mutual fund industry makes 25,000 crores a year. That is the revenues of mutual fund industries for that one word called outperformance. And outperformance is basically a matter of four decisions that fund managers take: what to buy, when to buy, how much to buy, and when to sell. Now, you can have quants doing all these four decisions for you. And I don't think so that anyone uses AI or machine learning kind of things. That would be jargon. It's just that everyone's got models and processes for better decision making. So I'll come to what to buy. These kind of decisions, you can have multiple frameworks. Like we at Stallion have got 20 frameworks. I'm sure Sonam and Anirudh also have great frameworks for what to buy. So fundamentally, what we are doing is we're dividing decision making, and these are very like these decisions is what you get paid for. If whatever I make, Anirudh makes, or Sonam makes, is because of the decisions that we take. And fundamentally, we're all trying to make better decisions on these four matters: what to buy, when to buy, how much to buy, and when to sell. AI, machine learning, if we think money is getting made there, we'll go there also. But for now, we've stuck to our frameworks, and great returns I see getting made staying in these frameworks. And I'm sure there'll be models that everyone would be using, that how much to buy whenever they select a security, how much to buy, should you buy, and that may be on risk management systems, that I think I will lose 10% on this, that my worst case scenario is a 10% loss. So I don't want to lose more than 50 bips capital on this trade. So I can go up to 5%. So basically, there'll be multiple how much to buy options. When to sell will also be based on other opportunities, or you think the markets are bad. So there are decision-making frameworks that every investor has to create. And yes, you can do it via quants, but quants, I think, will also have a human element, because what the system has to do, someone has to tell the system, right? So, yeah, that is how it is, Kamalji. And there is no thing as machine learning, AI. Even the Medallion fund is a $10 billion fund. So the best performing fund, which is Renaissance, is a 10. The other funds that Renaissance manages, they've been underperforming for a very long time. I'm not saying quant is bad investing. It's great investing. You have to follow your processes, and it makes sure that you're following your process. And you do any strategy, be it moat investing that Warren Buffett does, reversals that Paul Tudor Jones does. Peter Lynch divided his investing in four parts: cyclical, fast growers, the slow growers. Basically, he was also following a pattern. There's a book called Market Wizards by Jack Schrodner, and this was written in 1991. And in all these 20 odd traders, he and the best performing, like Ed Sekiota, he did trend following. Everyone was following a pattern. The fundamental thing is that you need to follow your pattern. You need to know what's your risk. And as long as you do that for last 30 years, 100 years, things have remained the same. We can call it different things, but broadly, everyone's following a pattern on these four methods: what to buy, when to buy, how much to buy, when to sell. There is nothing beyond this.
Right, Amit. So moving on to you, Sonam, I have my bias towards human-based investing. I'm being very honest, and I know many clients because I've been doing client management for last almost 2 decades who have their bias towards human-based fund management. And obviously, we all are learning, and that is the reason this question to you. Over next 3, 4, 5, 6 years in this decade, we'll see multifold growth in Indian economy. We'll be maybe adding 1 trillion to Indian economy every 2.5, 3 years. Now, when such massive growth will happen, buy and hold kind of an approach, which primarily a human fund manager with his intuition, with his understanding of the visionary leadership, good management, because at the end of the day, he needs to be convinced during non-linear period of the stock where stock could go down also because of few bad quarters. But it is the human fund manager's intuition and conviction which will allow him to hold on to that stock for long term, and he will participate in that entire growth. But in this entire process, how will quant be able to keep that conviction during bad quarters when kind of the stock is showing lower signals but otherwise business is doing good? Because in my understanding, quant cannot go and meet the management, and that angle will
Hmm.
ultimately be missed. So hence my bias is towards human based fund management, but I'm absolutely wanting to learn from you, how will
Right.
this entire thing be steered by a quant kind of a model?
No, I totally understand, Kamal, the bias that, people who work with smaller companies, going and seeing the plant, going and meeting the management, it does make a lot of sense. So as a quant right now, if I look at the market, I am actually constrained that I cannot go to very, very small companies where, I don't have reliable data because I am just working with data. But having said that, using quant, you can again capture so many of these uh, you can create like I think Amit was saying that quant is all about process, but with quant you can identify uncorrelated factors, right? So I could have a philosophy that I do momentum investing, right? And suddenly momentum is not working, and I discover that okay, maybe looking at the valuations of it, maybe looking at the quality of it, which are all uncorrelated, gives me a much more stable exposure. uh, so quant can give you different flavors. You can combine uncorrelated things and uh, get a much more stable output. And it's not about that if you are a quant you have to trade every month or every week. Quant strategies, there are a bunch of quant strategies that are designed to do buy and hold, that are designed to only sell after a year or after 6 months. So there is no definition of that a quant will be actively trading. We as a quant firm, we like to be a little bit tactical because we see this opportunity in India where we definitely there will be massive growth, but there will not be one thing that will grow, right? There will be different sections in the market that will grow at different times, right? Let's say during COVID, chemical stocks, after COVID, chemical stocks picked up, but then for a few years they did not work, right? So as quants, we shifted out. We have changed the flavor. We went to IT. We went to infrastructure. We have, we have changed. We changed with the times, and that is the philosophy we believe in. But as quant, there is no one thing that you can do. So definitely, I think given the dynamic opportunity in India where things are moving, shifting very rapidly, having a tactical approach works. And even understanding management biases, so something that you were talking about, understanding the management. So as quants, we've been trying to analyze news data using a little bit of generative AI to capture sentiment, capture events before they become market moving news. So all of this is happening, and there's a lot that you can do, and we are very, very excited about it.
Sure, Sonam. The same question revolves to you, Anirudh. What is your answer to how quant will take all these decisions over next 3 4 years? I know in your portfolio you have not churned for a long period of time. You have been holding old economy stocks, but I'm sure quant will be giving you some signals whereby maybe soon, as you have been hinting, you will again be moving out. How will you catch that moving trend? And if you kind of catch that trend, how will you validate that? Because you're not meeting managements, you're just seeing screens, just screen all these signals. Hence it is like, as a I would say human biased investor, I want you to give us some insight.
Sure. So, Kamal, the quant models, they don't have to be black and white. They have ample opportunity for you to do to be in the gray area. Why cannot a quant person go and meet the management? So, what we do at INVasset is, you were asking what is the factor that we look for? We look for something called relative change. what has changed in the market in the last 3-4 years, where are the tailwinds coming from, how big is that change, and how will it translate into the top line and bottom line of the companies. Now, once you have spotted that relative change and you are able to spot the top 100 companies where relative change is maximum, that is for us the main set, the sample set to work on. Now we have 100 companies where we feel that they have some advantage over the rest 1400 companies, and let's devote our research resources to these particular set of companies. So once we take out these 100 companies, our research teams, which are proficient, we have a 12-member research team. They are proficient in what research they do. Every research that we have done till today, we have published it on our website. So they go and meet managements wherever necessary. Sometimes I've seen personally that meeting the management for somebody who's not very seasoned into research actually gives a wrong impression. Sometimes you get biased meeting the management. Sometimes you have experience there where you're not able, which biases your opinion towards the company. So there has to be a factor for everything. So quant can be very, 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 very diverse. You just have to make sure that you use it the right way. So we have been using quant, as I told you, to get those 100 companies, then work on those 100 companies. Once our research team tells us to buy the company that the quant has given, how does quant improve itself? As Amit said, the humans, they give their feedback to the quant. I would say the intelligence of the system increases. So yes, I would say quant plus human is the next thing. So if you can get a little bit of advantage over what sample set, we see it from the sample set point of view. And yeah, that is why we think that, I'm not getting into those 100, 200, 250 companies. Rather, quant gives me an advantage of the next 100 companies that are out there. We believe every 3, 4, 5 years, India, such a multifaceted stock market, it gives you new leaders due to the change that has happened. And that opportunity is something one should look for.
Sure, Anirudh. So moving on to you, Amit, I have been conversing with so many clients about Stallion because Stallion is a fund that we have been kind of talking about for a long time. I can tell you there is one reason which is common to investors, which makes investors like Stallion, and the same reason is what makes investors dislike Stallion. I think Anirudh is also one of the clients of your strategy. But anyways, I'll tell you what is that. One thing is the way you churn in the portfolio, because when you churn in the portfolio, that makes investor like it, because then they kind of perceive that fund manager is doing something. Fund manager is actively managing it. He's not falling in love with certain consistent compounder kind of businesses, and he's doing something in the portfolio which ultimately is generating results also. Till the time it is generating results, obviously they're liking it. But at the same time, it makes people dislike because they feel that fund manager is changing his conviction. He's not kind of convinced. You did a lot of changes with Zomato, Nykaa, added, and then again, removed, and then again added. And then recently you have been doing with Polycab, with Angel One, with Mama Wealth. All this is going fine. But now over time, your AUM is rising. You have been doing all this on your own without probably following quant, and maybe following your hunch or following your human wisdom. But you were managing 500-600 crores till now, but now probably in this new financial year you will be managing more than 1500 crores. How will you progress, and how will you kind of ensure that future churning in the portfolio without the support of quant, as a human fund manager, you are able to kind of do it without any mistakes?
For Kamalji, we only churn when we think we have a better opportunity or we think there is risk on the table. If you see whatever churns we made, majority of them had a very positive impact on our portfolio. If there is risk on the portfolio, we cannot lose money. That is very important for Stallion, that we are risk managers. If you see on all counts, on beta, standard deviation, drawdowns, etc., we do okay on risk management. So for us, risk management is primary. And if that leads to churn, it leads to churn. And our churns will be at 50-60% a year, which is decent. Actually, now mutual funds are doing 300% churn. So I feel a little happier that my churn is only 50-60%. But regardless, See, Kamalji, the whole idea is that markets are getting volatile and cycles are getting short. If you think fundamentally think about it, the stocks, some of the stocks you named, if they're doubling in a quarter and doubling in like 5 months, and if I buy something at let's say 5% weight at 100 rupees, and my target is that it will go to 200. If the stock goes to 150, my weights, assuming all stocks remain same, the weights become if the stock goes from 100 rupees to 150 rupees, my weight becomes 7.5%. My return expectation was 100%. At 100 rupees, I was expecting 200 rupees returns. But at 150, my return expectations are only 33%. Okay. Now, but I now have higher allocation with worse risk reward. Now, what should I do? Should I say that because I bought it at 100 and now the stock is at 150 and my return expectations are lower, should I have same weight or should I have lower weight? It'll be very irrational for me in a bull market to have higher weights with lower risk reward scenarios. So that is all we try to do. We find discoveries. There are beautiful stocks and we don't buy bad businesses. So we don't have any exposure. They're great stocks, but we don't consider them to be like, if the kind of quality of stocks that we deal in are typically like top notch, majority of them, like 95% of them, I would say they're like class A kind of stocks that we deal in. And yes, so we want to be in good businesses till the time they are good at reasonable valuation. And when valuations change, we have better options. We move out and find better alternates. And this churn will not have any impact on the returns on your AUM. Will our churn? So we divide our portfolio in 4 parts. Proven monopolies, which is the large cap part, emerging monopolies. Then we have special situations. And now we have a 4th kind of thing that we've added, which is tailwind based investing. If you fundamentally think about it, we manage about 1,350 crores. And every framework will get 400-500 crores brought at max. So we are still like 400 crore fund. Like every fund will be like 400 crores, and there'll be 4 different strategies in one fund, which decreases your beta, because special situations will always be higher beta. Trend investing, emerging leaders will actually have lower beta, so basically what you're trying to do is a bouquet of the best 4 strategies that we think out there, and you get very reasonable return. So I don't think at 5,000 crores, you might say that this will have an impact. At 1,400 crores that we are today, I think it has no impact. Like I come to know, and if I think that my execution cost is going bad, my alphas, I'm finding problem, I will not take new money. That is for sure, because we are an alpha fund. Stallion Asset has creating alpha in its name. So it's called Stallion Asset, and then our tagline is creating alpha. If we don't think we can do that, we will not take new money. We are customer focused.
Sure, Amit. Moving on to you, Sonam. Again, I'll just remind you that I'm trying to moderate this panel realistically from investors' perspective, and hence this question to you. I know, you have been talking about a lot of success that Quant has achieved internationally in the West. And in India, obviously, the same could happen. But my understanding, again, and my investors and clients' understanding is that in the West, when we talk about quant funds, they are like more hedge funds, which are working on both sides. Pure long only quant funds, have they been really successful in the West is, the question which I want you to kind of address. And at the same time, why I'm asking this question, because, over last 3 years in India, we have seen quant funds doing well, but last 3 years was the kind of a upside in the market. Now, when we will see downside in the market, how will long only quant funds actually perform is something that is yet to be seen in Indian context. Hence, I am trying to correlate to give us some idea from the West that how quant funds, which are like purely long only funds, which are not doing long short and are quant, have done in the West.
No, definitely, Kamal. So, see, so I have a little bit of experience having worked on the global markets. I used to work in HSBC for around 3 years for the European and the Asian desk. And I tell you, the whole outlook is extremely different. So while there might be a long only or a larger client, not a hedge fund client, maybe a large family office, but still, when the global investor is looking at his portfolio, they actually are talking about it in terms of quantitative terms, right? They're talking about, okay, you're doing this, what is your exposure to momentum? You're doing this, what is your exposure to value, you're doing this, and they are looking at certain risk ratios. So I think that perspective itself is a little bit different, and I think that is going to change. Indians are extremely smart and extremely smart with their money. So I think the way in which people look at their investments is going to become much more quant driven, and that is for sure. And I started with quant. I've been doing quant all this while, and that is why I sort of love doing this. I sort of see there are so many benefits of using a quantitative approach, not just in identifying a factor or identifying a pattern, but also how you can size your positions, how you can forecast risk in the market, how you can do bunch of different pieces of the whole process can be optimized and done so much well if you are doing it in a quantitative way. So typically, as a quant, what I would do is, let's say I have a problem in front of me that uh, how do I invest based on this number? I would experiment, take the data point, go to historical data, go to different scenarios, see what's happening, what I can do to optimize it. And that's what I love to do. And I think the perspective of the client, having seen the success of tech and AI in all the other fields, Indian investors, also want somebody to come and speak to them in data-driven fashion. And I think that is what a lot of our investors appreciate, and that is what we love to do. So I definitely see that shift happening where people start talking more data-driven fashion in India, and that is what I have seen in the West. Right? So even somebody who's managing a massive portfolio but doing a little bit tilt towards quality does a whole quant analysis and sees what happens, right? And I think that is the perspective that needs to come to the Indian market as well.
Sure, Sonam, well said. Moving on to you, Anirudh, we are yet to see how quant funds will actually perform when we'll see the down cycle and then when a recovery will happen in Indian context. And that's why I asked this question from Sonam. And I'm really sure that obviously, we'll see good outcomes. But if I kind of go back and remember 2020, March, April, whereby in March, market went down by almost 20%. In April, they recovered almost by 15%. As per my learning, many quant funds in April were sitting on cash because obviously, as you also mentioned, that your fund can go in 100% cash in stage 4, which is maybe one very attractive aspect about quant fund, which I have not heard Amit ever saying or any other fund manager saying that they will go 100% in cash. But you have mentioned that you can go 100% in cash. Now, going 100% in cash is appealing to hear now because we all feel markets have run up and we know that market can come down. But then again, coming out from cash and getting back into equity is where again you may take time, because that happened in the past also. And that is why I'm wanting to understand from you from March to April. In that particular period, I know I have read this in very various articles, various quant fund missed. And that is where those fund managers who did not do anything, who just remained calm, they ultimately kind of went down and came up. There was a bad phase for them, but they recovered also. So obviously, if Amit takes one bad decision in buying a wrong company, maybe he will lose 2% because he would have allocated maybe 10% to that company at max. But if cash call goes wrong, that could lead to a massive destruction in the possible returns. And hence this question to you, Anirudh.
Okay. So a lot of aspects to your question. Let me try to answer them one by one. First of all, let's look at all the scenarios together. We'll talk about 2020, we'll talk about 2008, we'll talk about everything. So 2008, see, when you're a data person, you do every type of research. So in 2008, I have seen the best of the mutual funds and the best of the very good fund managers whom I really respect. Their portfolios go down 60%. So it is not that portfolios would not go down when there is a fall in the market. Quality investors in the 2020 fall went down around 20%, 25%. Went down around 28%. Of course, when you're taking a bold call of moving into 100% cash or something like that, there is a chance of going wrong. But everybody in the stock market is right. Your performance, your fund, your investing style should match your psychology. And you should be able to define and live up to the return percentage that you want. So our thing is 18 to 28%. If we are able to deliver that, over a 3 to 4 years period on a CAGR basis, we are very happy. We believe a lot of like phenomenal wealth can be generated. Now, our thing is we have to take the calls according to what we believe is right. How, so whatever we have done, we have back tested it for the last 35 years, implemented it for the last 10 years, and it has proven to be well for us. So please, Kamal, always remember that it is, it is not only the India story that is out there. You're buying, you're not going and taking the company and putting it in your bag and taking it home. You're buying a stock. Okay. So in the stock market, you have to be really sure what the valuations are, how are they currently placed. You can just take a decision based on the risk reward ratio, which is out there. So when the risk reward ratio turns sour, it is good to move it into a little bit of cash. We never move 100% into cash. There are so many options out there. You get special situations when the markets become expensive. You can, reduce the beta further. You can, with the coming of the options, especially the index options, there are so good hedging options that are available out there. So there are multiple of options. It's not as I told you, it's not as black and white with quant as it may seem. It's a combination of your human intelligence and your quantitative models. But yeah, I have seen it in the past. You were talking about the April, March, April. I see it the other way. Being in quant and adaptable to different type of strategies. We moved from quality, where our quality that time, we give a guidance of fall of not more than 20%, but our quality that time fell 28% for the month. But in the next month, that is around 15th of May, I remember we were hitting new all-time highs. Why was that? Because the opportunities which were provided to us in value that time, we were getting Tata Motors at an 85% discount. It was available at the minimum 100 days of price to book in the last, 20, 30 years. It's been listed on the exchanges. So quant does give you that, options and I would say the ease of change, not getting married to a particular type of investing. Though I believe this is a stock market, and as I told you, everybody is right here. Just stick to your basics, stick to your risk reward ratio, and take the best optimal decisions and create wealth for your investors.
Sure, Anirudh, you mentioned about quality, and that makes me ask this last question from Amit in this panel. Amit, you have been always maintaining that your portfolio is rock solid, it's quality. And at the same time, you're also, have been kind of saying of late that, in such type of markets where B2G stocks are doing well, your portfolio can relatively underperform. So which basically, trying to convey that B2G stocks as per you are not quality. So, as you are a human-based fund, where perception and human intuition works a lot. So, don't you see, given the new India, NTPC being a very moated business in power sector, it is also kind of a quality and definition of quality is changing, and hence you may change your perception.
So, Kamalji, quality definition is broadly companies who can reinvest capital at 20, 25, 30% ROICs, can grow at 20, 30%, and are run by entrepreneurs who want to make it large. They need a very large opportunity size. When I say I have quality stock, doesn't mean that they are the best, because then I wouldn't change them. But I keep changing them because everything is relative. And if I have better opportunities, I have no problem changing my stocks. I find 20, 25 entrepreneurs who are growing at 25, 30%. They're leaders, they're market leaders. They are growing at 2 times, 3 times faster than the industry. Great ROICs, great free cash flows, reinvesting them, entrepreneur driven. I'd bought, it's not like we've not bought B2G. Whenever we buy B2G, if I buy B2G, I'll tell you B2G will top. So that's why I'm letting Anirudh and other people make money. So, they should thank me for it. But I know this is out of it's not my cup of tea. ये अपना line नहीं है. See, if my line is doing something and it works well for me, and we're compounding capital at around 30% CAGR net of fees, then why do I change my lines and get into something which is not my cup of tea? Like RVNL example. Okay. Last 3 quarter growth has been 1%, like 1% revenue growth. There is no way, there is 0% probability, even if I bought it, I would have held on to it, because a 20-30% drawdown would make me very nervous, and I would sell my holdings at one go, because I know my patience, I know my brains cannot, I will not be able to get sleep if I have a stock which is growing at 1% in the night. There is always, say, we are growth investors, and it works so well for us that we don't look anything beyond that. ये हमारा line है. Like if today I will not do B2G, but let's see. If I find some B2G hyperscaler which is growing at 30-40%, I may look at it, and run by a very smart guy. I might look at it. Or, the guy has no role to play, like an MCX we have in our portfolio, but the management there has no role to play, right? Very less role to play the management has. So there, I don't care about the management. I care more about the business. I'm just giving, this is not a recommendation, of course. So you need to see. So this is what we try to do. And ये हमारा line है. There are 1,700 companies. Out of the 20 companies that we own, every quarter they are growing faster than the peer set of their of like that industry. And till the time that is happening, we are with the stock. And if someone else grows faster in that industry set, जो हमारे पास है, हम वो बेच के जो फास्टर ग्रो हो रहा है उसको ले लेंगे. तो हमारा कोई it's like a pattern, and it's a framework that we are also following, and that framework works very well. Also, the game is not about just getting rich, not just getting rich, but it's also about staying rich. If you have decent quality stocks and something goes wrong, and in the markets anything can go wrong, you will have an exit in decent quality names. In bad quality businesses, you may or may not have, like, your drawdowns can be very. So if your CAGR is 30% for 10 years, I'm just giving you an example, and then if you fall 30%, your CAGRs will straight fall to 20%. So one bad year after 10 years can screw up your entire compounding. So the whole idea is not just to get rich and stay rich. If you are in decent quality consumer or companies, less debt, less B2G kind of things, your betas are controlled. Our portfolio beta is 0.85 against Nifty 500. Against Nifty 50 is 0.77 on daily data for last 5.5 years. So we have focused on risk, and it works very well. And compounding is good. So Jai Mata Di.
Sure, Amit. So I'll just conclude by saying, from, for our clients and investors, if you want a fund manager to focus on business, give money to Amit. And if you want, fund manager to focus on right stock at right cycle, then give money to quant-based fund managers. We have two best quant-based fund managers and one human fund managers in this forum. Thank you so much for